All right, we're just getting started. Thank you for joining me. Hey there, I'm Mitch Goldberg. You're watching Be the Boss of Your Money. It's a post-market show. I talk about stocks, any facet of investing really, interest rates, mortgage rates especially. We talk about a lot lately, but personal finance is the name of the game here, and it's all about helping you take control of your money. I've been doing this show now. I can't believe it. It's been about 2.5 years. I've got a lot of new viewers. I'm connecting with a lot of new people on social media, and I really appreciate everybody who has taken the time to join me in this endeavor. And it's about helping all of us become better with our money, better at personal control of our money. That's why I call it Be the Boss of Your Money. We talk about other things too. I'll be having some more guests on about the housing market. I'll have some guests about Medicare plans, Medicare Advantage. We have all of these things um, going on, lots of things in the hopper. So I'm looking forward to bringing you so much information. Today, though, was a bit of a ho hum day in the stock market. Not a whole hell of a lot going on. Just more or less back to worrying about things 2 weeks ago. Last week was a very good week in the stock market, a big rebound. The rebound from last week is starting to fade a bit. And we've eaten into a good chunk of last Friday's big gains, but we're back to worrying about the macroeconomic picture. Macro means big picture stuff. So we're back to worried about statistics like plunging consumer confidence, um, decline in home building, home sales, you name it. Things are slowing down. High inflation, interest rates, a Fed that is determined to squash inflation. That's a big thing to have a Federal Reserve that is determined to fight inflation. So just like before we had inflation, the Federal Reserve Bank of America of the United States says we will let inflation run a little hot because we want to make sure inflation can stick around. That's what they said. Well, inflation is hot; it's sticking around. And now they're going to go the opposite direction and say we need to make sure we squash high inflation. And even after it squashes high inflation, it'll probably stick around with that plan to squash it even more. And that's just not good for the market. It's not good for the economy. But it's not supposed to be good for the economy, short term anyway. Short term, Fed raises rates, it slows down demand, just makes everything more expensive because it makes borrowing more expensive. It makes credit more expensive. Long term, high inflation is a lot worse than high interest rates. Okay. High inflation long term is a destroyer of wealth, personal wealth, your wealth, my wealth, and the economy. Uh, High interest rates will hurt demand and hurt everything, the economy and the stock market. But after that, you could then lower rates and get back to growth. It's just, we can't get out of this cyclical, we can't escape the cyclical forces of the economy, and everything is cyclical, be it the stock market or the economy. It's just we go through the cycles, and there's really not a whole hell of a lot that we could do about it. Anyway, let's run the intro. We've got a quick show today for you, just because not a whole hell of a lot's gone on. There's not a whole hell of a lot of news, and here we go. Okay, thank you so much for joining me. We've got a couple of things to talk about. We'll get through the stock market, what happened today, but there's no major news today. I mean, I think the biggest corporate news that came out in the last 24 hours was Nike. Nike reported earnings slightly better than expected. They are still cautious about their outlook because of shutdowns in China, but it doesn't matter. The stock went down. It went down a lot today. Um, it's one of the reasons why the Nasdaq went. I'm sorry. It's one of the reasons why the Dow went down so much. Nike is a Dow component, so like when we're in a bull market, uh, stocks go up, whatever the news is. Earnings were light or the forecast wasn't so great, but things are going to be great. So the stock market goes up. That's a bull market. You could say the same exact thing in a bear market, and stocks are just going to go down. That's the classic sign of a bear market that, you know, no news is good news. Or I should say all news is bad news. That's a better way to put it. So that's where we are today. Now, while you're watching, hey, give us a thumbs up if you don't mind, an applause, a wow, a heart, depending on which social media platform you're watching from. This way, I'll see you out there, and it helps spread news of this live stream, and it helps the algorithms on all the social media channels uh, push out the show to more and more people. We are streaming. We are streaming now to YouTube, uh, LinkedIn, Facebook, and Twitter. Instagram, I post all of my snippets. Same on the other channels also. So keep in touch with us. Follow me on your preferred platform. And while you're watching, of course, if you have any questions, I would love to hear from you. So go ahead, ask a question in the comments. I will see it. I'll put it up on the screen. I'll answer it. Hearing from you is the best part of doing this. It's the by far it's the best material that I could have, because if you have a question, it means probably other viewers have the same or similar question, and words of encouragement and words of wisdom in the comments are always appreciated as well. Or just say hello, okay? Let's take it to the board and see how things look today. Pop myself up here. All right, so the Dow is down almost 500 points, eating into last week's gains. Nasdaq was down almost 3%. That's pretty significant. It's down percentage-wise. The Nasdaq is down percentage-wise, almost double that of the Dow Jones. It's down a lot more percentage-wise than the S&P 500, which was down 2%. By the way, you cannot invest directly into an index like the S&P 500, Dow Jones, or Nasdaq, but you could invest in a security that tracks or mimics those indices. Just want to let you know, gold just never goes up. I have clients in gold, the GLD ETF. And sometimes I just wonder, what am I holding on to this for? It's like, at this point, if it's not going to do anything, it's not going to do anything. By the way, just a quick shout out to Tom. Tom, I'm glad you're out there. Thank you very much. Rita, thank you so much for the heart and all of your support. Rita does a lot for me in the background, and it is greatly, humongously appreciated. Anyway, oil up nicely, up 2.4 nicely. That's like, we don't want it to be up nicely, right? We want oil to be down nicely, but oil is up. The 10-year yield rates, the interest rate in the 10-year was off a drop. It was up a drop. Now it's off a drop at the end of the day. No big deal. The VIX was up to 28, up over 5%. So you see that VIX is up 28. We see that go above 30. That's like my opinion. We see that get up to like 32, 35. Then the rally last week, we just kissed that goodbye, and we go right down. Okay. And Rita says, Bob says hi too. Hey, Rob. Oh, excuse me. Rob says hi too. Hey, Rob, how are you? Thank you so much for your support. I hear you listen to the show or watch the show in the morning, and I really appreciate that. Thank you very much. And let's take a look at the bond market. All right. So interest rates were basically mixed, but long-term rates, the 10-year, 20 and 30-year rates were down a little bit. These moves that you see in interest rates being down a little bit today, I think what it really reflects is that the stock market was down a good amount. So investors sought a little bit of a safe haven in the in long-term treasuries. But these little tiny moves in treasuries don't really move the needle for anything. It doesn't make a difference, for stocks or what have you. All right. So today is going to be a quick show. There's really, just like I said, there's not a whole hell of a lot of new news out there. We're just back to worrying about the macroeconomic picture, big picture stuff like consumer confidence, inflation, interest rates, and all of those things are still looking pretty bad. My thought process is that if the economy does slow down significantly and quickly enough to get the Federal Reserve to back off of its tightening policy, meaning of raising rates and whittling down its bond portfolio, that would be very good for the stock market. Day like today, you could tell that, nah, we're just going to keep worrying about the same stuff. A lot of people say, investors, a lot of the pros say, well, if we avoid a recession, stocks are cheap. If we go into a recession, stocks could have further to go down. I think we're already in a recession. I've been saying that for a long time now. But if we do go into a recession, I think stocks could go down a little bit more. I think it would actually be worse if we don't go into a recession near term, because then the waiting for the recession to preparing for the recession. I know. I just said I think we're in a recession. I do. But statistically, that has not been borne out yet in the economic statistics that most people follow. But I think we're in one. All right. I'm sticking to my guns on that. Thank you so much for watching, and I will be back tomorrow at this time. Have a great night.